From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a tick up in the Fed's preferred inflation measure as tariffs work their way through the U.S. economy, leading to consumer sentiment sinking to a 3-month low, and Fed Governor Lisa Cook suing President Trump over his push to remove her. We begin with the big issue, pressure building on the Federal Reserve.
There's an enormous amount of pressure on the Fed right now that cannot be ignored.
This is a real assault on the Federal Reserve's independence.
Which means higher inflation potentially, less credibility, even higher long-term interest rates.
I don't think we should be too confident that this is going away anytime soon.
The Fed is under a lot of pressure in terms of the future policy path.
This is a Fed that's going to proceed with a series of cuts.
Ultimately, the Fed is on an easing trajectory.
The dovish side of the FOMC may have taken control.
Inflation is very, very important.
At the end of the day, 3% is still not the Fed's 2% target.
The jobs data next Friday is going to decide for sure whether or not we're getting that first cut.
Any kind of cuts are going to come with a steepening.
You will get lower short-term rates.
We're more nervous about the long end.
What you're seeing in the long end is certainly somewhat worrisome.
By the end of the year, we're at 450 on 30s.
Bonds here look like a good buy.
The market's just a little bulled up on the Fed steepening the curve.
Well, let's take a look at the trends developing in inflation. You had today's print showing progress stalling on the path to the Fed's 2% goal. We stacked up all your different measures here. You have PCE, CPI, and PPI. PCE, that's in white. That's what we got this morning. As you can see, I mean, it's not going higher. Maybe you could get a little bit worried about what's going on in yellow with PPI. But overall, it seems like we have stabilized on inflation. And the idea here is that given that we are sort of trading sideways, that's probably not going to derail the Fed, even though we are still some distance away from that 2% target. Let's take a look at how this is playing out on the Treasury curve, specifically on all the different yield curves we have to look at, the 5s, 30s, the 2 cents, and the 2s, 30s. You can see that the trend really since about mid to early 2023 has been to trade steeper. That steepening trade has been on for a while, and really it started to work this year in 2025. Maybe some stalling out when it comes to the 2 cents in blue, but the trend is clear. We're going higher on those yield curves. Let's stick with the Fed because Scott Alvarez, he is former general counsel at the Federal Reserve Board. He joined Bloomberg TV yesterday and spoke to the challenges facing the central bank.
I think it's definitely worse for the institution if the president can fire a member of the board at will or based solely on an allegation that's unproven, undemonstrated. I think in that situation, there really is no independence of the Federal Reserve and its ability to act. And that's got to set markets, make markets uneasy.
And let's keep the conversation going with George Bory. He is Chief Investment Strategist of Fixed Income over at Allspring Global Investments. And Priya Misra, Portfolio Manager over at JPMorgan Asset Management, Core Plus Bond ETF. Priya, I'll start with you since you are sitting in studio with me here. I want to start with this morning's PCE figure. Of course, coming in bang in line with expectations on pretty much every single measure. What do you make of a print such as that, where there were no surprises at all when you're thinking about how the Fed is actually going to proceed next month?
So with everything that we're dealing with this year, a number that comes as expected is actually not a bad thing. We're hoping for a quiet day. So it comes in as expected. To your point, it is above the 2% inflation target, but it was not higher. So at least that was good news, particularly as the Fed, as Chair Powell seemed to indicate, is on this risk management approach. We had that weak payroll report with the revisions. I think there's concern at the Fed, and I'm maybe part of that group, concerned about is the labor market losing momentum. And they know that monetary policy is restrictive. So I think the inflation report allows them to reduce the level of restrictiveness. We know we're living with tariff. The dual mandate of the Fed is in tension. But the inflation number hasn't picked up to the point where they might say that, hold off, we really can't start to cut rates. So I think the inflation report allows them to cut rates, as they've signaled. That labor report next week is really important, whether it's a 25, 50, what happens after the 25? I think that's what we need to see. We know the labor market's slowing. Is it slowing in line with structural issues because the break-even numbers are lower because of whether it's AI or immigration, or is there something cyclical? I think that's the big question we're grappling with. Ahead of that, I think the Fed, so what this means for the Fed is I think they can cut that 25. It's really what's next, how many more cuts, where's the end point? All of that, I think we need that labor report, I'd say more important than even that inflation print today.
Well, let's bring that topic over to George Bory, because Priya makes an interesting point that, okay, you take a look at the odds for a September rate cut, they're hanging out at about 88% right now. I'm going to go ahead and call that a lock. But when you consider the trajectory beyond next month, George, is it going to be the labor market that is the key?
Well, as Priya mentioned, it's very much, they're still data dependent. Whether we want to call it that or not, they are data dependent. There's certainly air cover, there's room, there's rationale to start to cut rates. The labor market is showing clear sign of deceleration, and there's a very mixed bag of growth. That on average growth also seems to be slowing, although the second quarter numbers still looked pretty solid, and third quarter's holding up reasonably well. But with the labor market showing signs of slowdown, they can cut. It's just a matter of pace. And I think that's what you're mentioning is absolutely critical. It doesn't appear to need to be fast and furious at this point, that you can start to incrementally lower rates, align that with a labor market that's showing some sign of softening. But you have to be very respectful of the inflation backdrop, which is kind of stuck. We're stuck at slightly above target. And the question is that going to go down? It doesn't appear to be going down anytime soon, but if the Fed wants to look out a little bit over the horizon and say slow and steady for now, and then we'll have to see how inflation evolves, that seems like a very practical, very realistic approach at this point in time.
Well, the phrase that we're using, George, stuck when it comes to inflation, I mean, I think the chart told the whole story. That looks like where we are. And I want to talk about this in the context of the Fed's dual mandate. You have the labor market, you have inflation, of course. That's what the textbooks tell us. Do you think that those two sides are in conflict? Because if I take a look at today's reading, core PCE on an annualized basis at 2.9%, if the labor market does weaken materially here, I mean, what kind of magnitude can we talk about when it comes to Fed cuts with inflation still around those figures?
Yeah, that's an excellent point. And that's why we think it's going to be very measured. Like, they do have room to incrementally cut rates, but it's going to be meeting by meeting. That to be able to forecast sort of a rate cutting cycle that's going to drop 100 basis points or more, it's premature at this time. There is kind of the dual mandate conflict that you mentioned, and the other is with respect to inflation is to like, what will be the drivers to sort of bring it down? Does it have to be growth oriented, or can it be organic? Historically, it needs to be growth oriented to get inflation down. And from the Fed's perspective, we think there's really there's an important aspect to this. It's confidence, market confidence in its ability to get to target and to maintain their inflation fighting credibility. Powell's doing a pretty good job, but he's trying his best to preserve that, and that's what the bank overall is trying to preserve as we get sort of pressure from the administration to ease rates in the face of what is still very persistent stuck inflation. So we kind of watch the long end. We very much watch break evens. We're very much looking at term premium in here to kind of calibrate, like, is the market getting uneasy? There is some signs of that, as you pointed out earlier, but we haven't sort of fully capitulated. The bond market is still largely holding together, and particularly important, we think, are those break even inflation rates, 10 and 30 years out, which are holding in reasonably well, but still showing some signs of upward drift.
Yeah, absolutely. Well behaved for the moment, but as you said, also a direction of travel higher. Priya, George touched on the concept of Fed independence, and we have to get to one of the big stories that's happening this week, and that, of course, is what's going on between President Trump and Fed Governor Lisa Cook. What's interesting to me with all the drama of this week, of course, Trump asserting that he can fire Lisa Cook then suing Donald Trump, is that you really haven't seen much reaction in the bond market. We know what the worst case scenario might look like, long end yields going higher, but haven't really seen that anxiety come through in pricing.
Right, and I think, we should look at the bond market, absolutely. I stare at it all the time. The curve has steepened a little bit, but I think you can attribute a lot of other things to that steepening. The fiscal trajectory, global term premium going up. But if really we were concerned about Fed independence really getting challenged here, I think equities would be much weaker. I think credit spreads would have been wider. The dollar would have been much weaker. There is uniform agreement among economists, among market participants, among global policymakers that you want an independent central bank. So I think it's one of the basic tenets of a developed economy of U.S. exceptionalism. I really think the market is saying there are institutional guardrails around the Fed, whether it's the Supreme Court decision from earlier this year, whether it's the fact that there is a diversity of opinion at the Fed. You really don't have clear political leanings at the Fed. I think, we've got the 12 people that vote. You've got that, all the board members. I think the market's saying this is sort of drama. We can look past it. I don't think the market's really seriously pricing in a loss of independence. It would be extremely serious if that happens. Maybe I'm naive, but I do think that those institutional guardrails are there to protect that Fed independence, because I think the president wants an independent, credible central bank, because that 10-year is the policing authority for the market. If the market gets a whiff of a non-independent, non-credible central bank, you're going to see those break-evens much wider. Long end rates will rise. The Fed really won't be able to control the long end. And then, that's when the bond vigilantes sort of wake up, and every market wakes up and takes, notice of that. So I think it is a risk. It's absolutely something we should keep an eye out for, but I would put that in the realm of a big tail risk, maybe starting to get priced in. I think the market's still looking at a credible central bank and the growth slowing, inflation staying sticky, and how we're navigating. Can we stay in that soft landing? And the Fed cut just enough to keep the soft landing going? I think that's the key focus. But you're right, we should all, I think, keep an eye out for whether that independence is threatened or not.
Well, we'll continue, of course, to follow what's going on in D.C., of course, court hearing today. George, Priya, great to have this time with you. That is George Bory of Allspring Global Investments and Priya Misra of JPMorgan Asset Management. Now, coming up next, the auction block. Junk bond yields falling to their lowest level in more than 3 years. We'll talk credit next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the auction block, where we highlight the big global debt sales of the week. And we start with treasuries. There were auctions for the U.S. 2, 5, and 7-year notes. We did see the 5 and the 7-year sale tail, but still come in at the lowest levels since last September. In credit, U.S. high grade saw a later summer slump as only a few deals happened this week. August volume falling just shy of $100 billion. The pace of sales, though, expected to pick up dramatically next week. And over in Europe, no summer lull to speak of, logging its biggest week for sales since late June. Deals were driven by French borrowers who came to market to raise cash before a potential collapse of the French government next month. That does not sound good. But back here in the States, Colin Martin from Charles Schwab says that he has credit concerns, even with spreads remaining tight.
I'm concerned that I think we're seeing a lot of dynamics with supply and demand, people really reaching for yield, stock market optimism, a lot of demand in the private credit space. And I think when we get all this demand moving into an asset class, I think you lose price discovery, and it can't mask things that are going on underneath the surface forever. And we're seeing, defaults are still relatively high.
Joining us now, we have Winnie Cisar. She is Global Head of Credit Strategy at Creditsights, and Jeff Peskind, the founder and CIO of Phoenix Invest. And Winnie, I'll start with you, because this has been the question for a while, right? When we take a look at credit spreads, whether it's in junk bonds, whether it's in IG, the fact that you have spreads so tight at these levels, what's the takeaway? Is this calm or is this complacency?
I think that the takeaway is that technicals can be a powerful driver of valuations. And that is perhaps something that people have continually missed really since the Fed started hiking rates back in early 2022. Attractive yield levels can be really enticing to investors. And when they are looking at yields versus equity levels and credit spreads being very tight, balancing off kind of all-in yield levels, we continue to just see robust cash coming into the asset class. And that can actually help fuel fundamentals as it leaves a wide open primary or new issue market, which allows companies to raise new liquidity.
Jeff, weigh in here. When you take a look at where spreads sit right now, I mean, what message do you glean from that, especially when you weigh that against some of the fundamentals as Winnie was just touching on?
Sure, it's a good question. I think spreads are relatively tight, which historically it gives people pause. But I think the bigger picture is the absolute yield on high yield bonds now. It's right around 7%. When you look historically at what you get in returns in the equity markets of roughly 8 to 10%, high yield bonds are now somewhat competitive. In addition, the fundamentals are very strong. The earnings that just came out, a lot of companies hit their numbers, showing good looking forward, very good opportunistic business fundamentals. Default rates, I think, are going to stay well contained. So the credit quality in high yield is good, and the yields are okay, especially when you compare it to equities.
It's interesting, listening to you both. I mean, this is something I think about when it comes to the corporate credit market often. Do you take a look at spreads such as that we're showing on the screen, say, wow, that looks super tight? Or do you take a look at the all-in yield and say, okay, this looks pretty lofty? And Winnie, I'll toss that back to you. It sounds like it's the all-in yield that you're really focused on here.
Well, we're focused on it to a point. We realize that investors in credit have a wide range of mandates. Some of them are looking at all-in yields. This is especially true in the high yield market, which has typically been a total return asset class. But when we think about investment grade, there is that balance of excess return performance, which doesn't look like it's going to be particularly strong going forward, given how tight spreads are right now, versus total return performance, which has been very strong already and could continue to prove stronger. What we're really focused on is that risk-adjusted return. When we look at investment grade total returns for this year, they're only lagging the high yield market by about 60 basis points. And when we think about some of the potential cross currents in terms of potential margin compression, what happens with rating cycles, what happens with downgrades, on a risk-adjusted basis, we don't think that you're getting as compensated in the high yield market as perhaps that almost 7% yield would imply.
And, we were just listening to Colin Martin over at Schwab. And I mean, Jeff, he made the point that he sees defaults staying sort of near these levels. He says that these are relatively high levels. Reading through the notes that you sent over to our producers, I know that you have a different take, that you look at defaults and say that actually they look pretty low right now. And from where you're sitting, does that lead you to want to take on a little bit more credit risk here versus maybe staying a little bit higher quality?
Yes, I do. I think the real value in the credit space right now is in the shorter duration, kind of off the run credit space, high yield bonds. You can get an 8 or 9% yield right now in some shorter dated high yield bonds where the fundamentals are in good shape. Default rates obviously go through these wild swings, like an 08 type of things where you get it over 10%. Long-term average has been about 4% default rates. You're probably looking at the next year and a half of 2.5% or so, 2.5 or 3. So defaults are behaved. Again, yields are pretty elevated, pretty competitive with what's going on in the rest of the asset classes. And again, the credit quality is really high historically. Again, a lot of the weaker credits are in the private credit space. These public bonds are at some of the highest metrics of credit quality you've seen in a long, long time. So I think when I weigh it all out, I think you're getting a good deal in the high yield market, especially off the run, shorter dated stuff. And if rates stay high-ish in the long end for the foreseeable future, these rates, I think, over time are going to be pretty compelling. And there's a lot of money still coming into the high yield market. The new issue market has been wide open. the next basically year to 18 months of refinancing that need to be done have basically been done already this year. So I think you've got a little line of sight for the next year or so where the credit quality is good, the yields are okay, and the earnings from these companies have been very strong.
Right. Well, Jeff, you make an interesting point, too, that when you think about the quality of the public credit markets, the fact that maybe some of the problem children are staying in the shadows in the private markets, that certainly helps. But overall, you're sticking to shorter duration. Winnie, I'd love to come to you on that question and how you're thinking about duration risk right now.
Yeah, so we've kind of neutralized our duration view, especially in the intermediate to long end of the Treasury markets. When we look at our fair value model assessment of 10-year Treasury yields, they're about 50 basis points higher than what our model would indicate. And as you discussed with Priya and George Bory, there are some reasons for that long end to be lagging a little bit, and some institutional concerns around the Fed, around fiscal policy, all of these things are probably keeping long end yields a little bit more elevated. But we do see the mix of opportunity if the Fed does start to ease on a more moderate pace, or if we start to see more contraction in the labor market, balanced out fairly nicely with some of the more significant questions that the market and investors are facing right now. Within the high yield market, from a duration perspective, it's really all about credit-specific catalysts and fundamental catalysts. We do see some opportunities for positive ratings momentum, continued upgrades into the investment grade space. We've seen some significant transactions that have been deleveraging, and that's where we're more focused.
All right, that's a good place to leave it. Really enjoyed this conversation. That is Winnie Cisar of Creditsights and Jeff Peskind of Phoenix Investment. Thank you. And if you can't get enough talk on credit, check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you got your podcasts. But still ahead, the final spread, the week ahead, a holiday shortened week ending with a critical U.S. jobs report. That's next. This is Real Yield. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up Monday, U.S. markets closing for Labor Day. Tuesday, Congress returns to Capitol Hill. That brings us to Wednesday when we get the Fed's beige book. Thursday, comments from New York Fed President John Williams. And Friday, the big event, the U.S. payrolls report. But that does it for us. Same time, same place next week. This is Bloomberg Real Yield. This is Bloomberg.